One of the benefits of investing is that it can be used to generate a passive income. You allocate your capital somewhere and that generates a stream of cash flows. But the question is, how much return can you generate? And also, what kind of risks are you taking when you do that? It's really important to understand the risks. So in this video, we talk about that range of income that you can get, but also the risks you take to generate that income. And if you do want to get more details about the funds discussed in this video, both for US investors and for UK investors, there's a spreadsheet which will be available to our Patreon supporters. So now let's look at income generation in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. This is a difficult time for income investors because yields are low almost everywhere. The Bank of England has a record of its bank rate since 1694, and you can see the rate has never been lower. It's very close to its zero lower bound. And if we look at the period since 2000, comparing the central bank's policy rate in the US and the Eurozone with that of the UK, you can see that the UK is certainly not unique. Interest rates are close to the zero bound across most of the developed world. Almost all developed market central banks have interest rates which are very close to zero, and some of them are already negative. Given that we live in this yield-starved environment, this begs the question, how do we get income? Well, one way is simply to buy shares. So let's say we invest in £100 worth of shares on day one. You can see we've paid out £100, which is why this cash flow is negative. For many stocks, this means we're entitled to a dividend. In this case, the dividend is £5. Now, the dividend for a stock will be variable. The reason for that is that the company's profits are variable, and the board of directors can choose to change how much of their profits they pay to their shareholders. So now the dividend has fallen to £3. Then it rises again to £7. But oh no, we've just hit a snag in the economy, and the current pandemic is one example of that. And as a result, the company's decided not to pay out any dividend at all, and that's to preserve its cash. Then once the company's fortunes resume, it may be able to afford to pay a dividend again, and to grow that dividend over time. But notice these three dots on the right-hand side of the graph. That's because a share is a perpetual instrument, which means that you'll be the owner forever. If we own a bond, the situation is slightly different, but it still gives us an income. Again, on day one, we pay £100 for the bond, and again, we get paid an income of £1. But then we'll be paid that £1 for every single coupon payment date. But unlike buying a share, a bond comes with a maturity date, and on that date we'll be repaid our £100, which is the face value of the bond, and we'll also get our last coupon payment. Notice here the coupons never vary, and if the issuer of this bond misses a single coupon payment, then they'll be rendered bankrupt. Now, for most investors, you never buy a single bond. Instead, you'll buy a bond fund. And what the bond fund does is it takes the pooled capital of its investors and it uses this to buy a portfolio of bonds. To make the diagram simpler, I've just shown 5 bonds, but in practice there could be hundreds or even thousands of bonds in the fund. Now those will be continually paying coupons to the bond fund, which then aggregates those coupon payments and pays them out to its investors in proportion to how much of the fund they actually own. Now, if it's an exchange-traded fund, this will be called a dividend, because the ETF trades just like a stock. Now, the actual contents of the fund are dynamic, and they have to be in the case of a bond fund. To see why, let's consider that we have a bond fund which buys 1 to 3 year US Treasuries. What that means is that it can only ever buy Treasuries which have 3 years or less until their maturity date, when the capital will be repaid to the fund. So on day one, you can see that each of the bonds owned by the fund have varying times to maturity. Some have 3 years to run, some have 2 years, and some have just 1 year to run. Now, after 1 year's passed, you can see that that 1 year bond has now become a 0 year bond. In other words, the bond has matured, and the £100 face value has been repaid to the fund. Now, if the bond fund did nothing, eventually there'd be no bonds left in the fund, and it can't let that happen. So instead, it'll use that £100 to buy a new 3-year bond. And the following year, that 3-year bond has now become a 2-year bond, and 2 of the bonds have now matured, which are then replaced with new 3-year bonds. Now, if more people buy into the fund, because it's probably open-ended, it'll have to buy more bonds. And if lots of people simultaneously sell the fund, then the fund will be forced to sell its bonds. So although these are called passive funds, they're anything but passive. There's a huge amount of trading activity going on in the background to ensure that the fund remains exposed to the correct market. Now, with an equity fund, there's never this problem with maturing bonds, because remember, equities are perpetual instruments. They never mature. If you buy a share, you hold it as long as the company continues to exist. But again, if many people buy the fund or lots of people sell the fund, then the fund manager will be forced to sell some of its shares or to buy new shares. Or if the index that the fund tracks changes because some new names are added to the index or removed from it, then the fund has to buy and sell shares to match that change. And the weightings of the stocks in an index will change on a daily basis. So even for an equity fund, it's an extremely dynamic process, as the contents of the fund change continually day to day. But just as with the bond fund, each of these shares will be continually paying out a dividend, which is then aggregated and then redistributed to the shareholders. Now, what's great about funds is that we can compare the income we get across different asset types, whether it's equity or bonds. That's because for an ETF, it's always expressed as a dividend yield. So let's see what that means. The dividend yield is a backward-looking measure, which tells us how much we've been paid over the previous 12 months divided by the price of the fund today. To give a simple example, let's say that one share of an ETF paid you £5 over the previous year, and if that ETF is trading today for £100, then the dividend yield would be 5%. Now, the dividend yield will change day to day, and that's primarily because of the daily price change of the fund. The income paid over the previous 12 months will vary very slowly, but that will vary too. But on a day-to-day basis, it's the price of the fund that's responsible for changes in dividend yield. If the price of the fund falls, then that boosts the dividend yield, because you don't have to pay so much for every pound of income. So now let's look at what's available for income for UK investors. As always, I like to use the Vanguard set of funds because they're finite, but also give you a fairly broad exposure to markets. This is the dividend yield at the end of September in 2020, with the highest yields here at the top and the lowest yields here at the bottom. And the one fund that really stands out is the UK Equity Income Fund. Now, that deliberately buys UK stocks which pay a high dividend, and has certainly been helped by the fact that UK share prices have fallen considerably due to the pandemic, but also to some extent due to Brexit. And this FTSE All-Share Fund, although it's not paying the 6% that the UK Equity Income Fund is producing, is still giving a fairly respectable yield of 4.8%. The next highest yield is for emerging market government bonds, and this is where you're lending money to emerging market governments. That comes with a fairly high credit risk, and because you're taking that high risk, you get a fairly high return. And the last one we'll consider is this Pacific ex-Japan stock index, which has paid a yield of 4.2%. And that's because this fund is dominated by Australian stocks, which, like the UK, tend to be high dividend payers. In fact, about a half of that index is made up of Australian stocks. Now, one of the drawbacks of that UK Equity Income Fund is that your capital will vary in value a lot because of the volatility of equity. So on the bottom axis here, I've plotted the 200-day volatility of each of these funds versus the income on the y-axis in terms of dividend yield. And although the UK Equity Income Fund gives by far the highest income, it also comes with the highest volatility of about 35%, which means that in a typical year, the price of this fund will go up or down by 35%. But given the choice, we'd much prefer to have a lower volatility with a high income, which is why VEMT, which is a US dollar denominated emerging market government bond fund, looks interesting. So it's always worthwhile to see what risks you're taking in order to generate your income. And volatility is a very widely used measure of risk, although there are many other measures. Notice that US investment-grade corporate bonds are also giving a fairly high income for a fairly low volatility. These are also helped by the fact that the Federal Reserve is buying investment-grade credit. Here I've used the application ShareScope to filter a wider range of UK ETFs. I've restricted it to large funds which have more than 800 million in assets, where the yield exceeds 3% and which are priced in sterling. And we can see a similar pattern to what we had for Vanguard. Now Vanguard doesn't have any high yield corporate bonds in it, only investment grade, but Ishares certainly does have high yield corporate bond funds, and these are the ones which give the highest yield of over 5%. Emerging market local government bonds, which are priced in local currency, also give an attractive yield of 5.2%, and again we can see UK equity is giving a fairly high yield. But of course that comes with a very high volatility. Here's one of those high yield corporate bond funds from Ishares, and the ticker is IHHG. And for this version of the fund, it's hedged back into sterling. So you won't be taking the currency risk of sterling versus the dollar with this fund. So it does give you exposure to sub-investment grade rated bonds, or junk bonds, or more politely, high yield bonds. But what it does do is give you exposure across different sectors. So at least you get some diversification. And the fund itself is global. So it's not just US high yield, but high yield from other countries. However, because the US market is so large for junk bonds, these completely dominate the index. And consequently, they make up 90% of the fund, with just a very small exposure in other countries. 2/3 of the fund are rated BB, and that's the highest rating, which is sub-investment grade. And most of the rest of the fund is single B. So when there is a credit problem, expect the default rates for this fund to increase significantly and for the price to also fall significantly. And it's slightly worrying that about 1/5 of the fund is in energy, and given the price of oil remains weak, that doesn't bode particularly well for this fund. Another form of credit risk is when we lend to emerging market governments. This fund is SEML, also from Ishares, and in this case it is in dollars, so you will be taking the currency risk. But notice that that's in addition to the local currency risk that you'll be taking with emerging market government bonds. What frequently happens during an economic downturn globally is that there's flight from emerging market currencies. Those then weaken and reduce the value of these emerging market local government bonds. So just be aware of that possibility. That's one of the reasons why the yield is so high. You are taking that risk. And if we look at those currencies to which you have exposure, the most liquid one is probably the Mexican peso, which makes up about 1/10 of the fund, but we also have a very significant amount in Brazilian reals, 2 Asian currencies, the rupiah and the baht, but also the rand, the zloty and the ruble. And that reflects the geographic breakdown of the fund, which is heavily invested in Mexico, Indonesia, Brazil, Thailand, South Africa and so on. Although these are very risky credits, at least it does have some diversification across continents. And although this is emerging markets, quite a few of those countries are investment grade, i.e. BBB rated or higher. Those make up more than 3/4 of the fund. But 1/5 of the fund is lending to emerging market governments which are sub-investment grade. Instead of looking at ETFs, we can also look at mutual funds, or as they're called in the UK, open-ended investment companies, or OICs. I've screened here for funds which have more than 2% yield and at least 800 million in assets, with a maximum expense ratio of 0.4%. And here are the funds sorted by their 12-month yield. Now you can quite easily spot the ones which are actively managed because they have a higher expense ratio. For emerging market bonds, I'd consider anything more than about 0.3% to be expensive. A lot of them cover the asset types that we've already looked at, but I'm going to look at this fund in particular because it's the fund we saw earlier on, which is the FTSE UK Equity Income Fund. As you'd expect from Vanguard, the ongoing charge is very low, at 0.14%, and the fund specifically buys companies which have a high dividend yield, and that's 119 stocks as of August 2020. But notice that the risk level is 6 out of 7. And that's because this is an equity fund. That's going to come with high volatility, and it's going to put your capital at higher risk than if you'd invested in something like investment-grade corporate bonds, for example. Another thing to be aware of is a strange sector composition for the UK compared to global equity. What I've done here is I've compared the UK sector composition, which is here on the left-hand side, with the sector composition of a global developed market equity fund, VWRL. The thing which really stands out is the huge technology underweight for the UK. Globally, you'd expect something like 22% tech weighting, but for the UK, the tech allocation is almost zero. That's partly because tech funds tend to be growth funds, not income funds. They don't pay out a high dividend, they reinvest their profits, but it's also because the UK has very little tech compared to global averages. Another thing to consider is a very small size of the UK market. If you possibly can, you should try to avoid a domestic bias. That's particularly important for the UK, where the market capitalization of the whole FTSE 100 is under $2 trillion. In other words, the whole of the FTSE 100, as of September 2020, is worth about the same as Apple, a single US stock. And even if we look at the whole UK market, that's still only worth 2.4 trillion. So I wouldn't be surprised if Apple overtakes the entire UK stock market sometime soon. So I wouldn't put too much into UK dividend funds. Do try and diversify, even if you're going for income. If we do a similar exercise for UK investment trusts, again screening by yield, here I'm looking for a minimum of 2%, and by size, a minimum of 800 million. What really stands out for the investment trusts is the very high expense ratios. Many of them are over 1%, and not many of them are less than 0.4%, which personally I find very unattractive. If we look at the US income space, as you'd expect, you get a much bigger choice. If we look at this plot again, with volatility on the x-axis and dividend yield on the y-axis, where I've got a cutoff of 8% for the yield, you can see that you still have a very large selection of funds. Even if you go for fairly low volatility funds, and here the volatility is around 10%, these covered call ETF funds give you a pretty good income for a fairly low volatility. But if we look at the reason for that, which is the year-to-date price change for the fund, you can see that for many of them, they've sold off by more than 20%, some of them by more than 40%, which is what's boosted their dividend yield. But notice that those covered call ETFs haven't sold off so much because their additional income comes from the fact that they're selling upside call options. And if you want to learn more about that kind of fund, I've done a whole video about it. So even in this low yield environment, it is possible to generate an income of about 5%. But to do that, you'll have to take some kind of credit risk, either in emerging markets, or perhaps you're going to lend to corporates in the US, which are slightly shaky, or you could invest it in something like the UK stock market, which tends to be a very high dividend payer. But again, there your capital is at risk because equity is volatile. If you do want to keep abreast of how changes in economics are affecting investment, then why not sign up to our free weekly market roundup? It's completely free, and there'll be a link in the description below and above me. And as always, thank you for listening.